as you mentioned, last year we were very pleased to have Mark Carney address TUC Congress in Liverpool. Really pleased, not least because for months afterwards, every TV and newspaper picture of the governor featured him under that TUC branded slogan, "Britain needs a pay rise." Can't pay for good money for that. But Mark's message to Congress, I think, chimed with some of the themes that you've drawn out today, that the recovery is real, but it can't be taken for granted, that the bounce back in wages and living standards is not universal and has a long, long way to go, and that a full recovery in the labour markets will be critical for future performance. Now, of course, the bank's decisions must take into account rapid change in the world of work. And you've talked a lot about new technology, although I would argue it's not an act of God. We can shape the way we use technology and who benefits. But for sure, greater labour mobility, the decline of jobs in the middle, and of course, an ageing population. And those are all powerful drivers for change. And as Andy has argued, we are at a pretty crucial point in the economic cycle with signs of growth slowing in the second half of this year. So for all that the recovery has been trumpeted, remember this still has been the slowest recovery on record, and it has been dependent on super low interest rates. There remain chronic imbalances, manufacturing back in recession, high and increasing levels of private debt, a dysfunctional property market booming, topic for a session in itself, and of course huge regional inequalities. As the OECD warned earlier this week, we've got some big headwinds coming our way too, not least the slowdown in growth in China and volatile commodity markets. Now, our judgment here at the TUC is that the recovery looks worryingly familiar, all too much like the pre-crash economy. Too much short-term thinking, too much inequality, too much wasted human potential. But we should have confidence, more confidence, in our ability to create the kind of economy that we need. And we should recognise explicitly how much this depends on the political choices that are made. Now, the Chancellor, of course, is choosing to impose severe cuts on our public services and, into the bargain, picking a pretty pointless fight with unions. But he could make different choices. He could choose to work with unions to deliver the new economy that we need. So what's the alternative that we want to see? Our first priority must be to address that persistent productivity shortfall that's all too familiar in the UK. Suppressed demand, excess spare capacity, and unimaginative macroeconomic policy have all hindered our ability to close that productivity gap as a nation. Productivity is around 17% below where it should be on pre-crisis trends, and the stark reality is, as we all read in the press, at face value, workers in France and Germany produce more by the end of Thursday than their British counterparts do in a whole week. That's certainly not because workers in Britain are lazy, and certainly not because they have longer holidays. The terrible twin of Britain's low productivity is, of course, low investment, including in skills, and very worrying recent figures on employer spend on training. Then there are wages and the quality of work. We may have a record number of people in work, but we also, as Andy said, have chronic underemployment and a long tail of low-skilled, low-paid jobs. On top of that, there is weak wage growth and, of course, what is an obscenely unequal distribution of rewards. As you've already said, 1 in 5 jobs now, nearly 6 million people who can't afford a decent life because they're on less than the real living wage. one of the worst records, by the way, in the OECD. And planned cuts to tax credits would see what is a lifeline for many low-income families stripped away. Now, while real wages have begun to recover, in part driven by unprecedented low inflation, working people have experienced the most significant reduction in pay since Victorian times. So we need to build a labour market where it's not just our employment rates, but our performance on productivity and pay, which is world leading. That's the only way to deliver decent living standards and economic security for businesses and families alike. But all too often, employers find it easier to hire cheap labour than to invest in new technology skills and ways of working. In some ways, it's the other side of the coin, Andy, that you were talking about. The need for secure jobs that pay a good wage must rise to the top of the public policy agenda, and we do need a grown-up dialogue between government, business and unions about how we deliver them. But our so-called productivity puzzle will not be resolved if we stay on the current course. Strong and sustained growth needs a rethink of how we do macroeconomic policy, for the government to act on demand and put in place supply-side policies that work. The government's policy of extreme cuts has meant that demand has been unduly depressed for over 5 years now. And that policy mix of relying too heavily on monetary policy while severely cutting spending has exacerbated imbalances while restraining demand and the ability of the productive side of the economy to move forward. As Ben Bernanke, the former chair of Federal Reserve, has argued, too much burden has been put on central banks to carry the recovery, and fiscal policy has focused too much on short-term cuts. Instead, we need a more sensible approach. And with interest rates at historic lows, what better way to boost demand than borrowing to invest in infrastructure? Not just creating good, well-paying jobs, but building the houses, the new roads, the railways, the airports, energy and telecoms that will generate our future prosperity. Sadly, I'm not holding my breath because it looks like none of this is going to happen anytime soon. With legislation requiring the government to run a surplus during so-called normal times, the Chancellor has already ruled out any kind of fiscal activism, a bit like a football manager insisting that his team has to play the entire game sticking to their own half. Earlier this week, in the wake of growing worries about the weakening of the world economy, the OECD came out with their strongest statement yet, supporting expansionary policy. Not only did they argue for, and I quote, taking advantage of low interest rates to increase public infrastructure investment, including to tackle climate change, but also that in economies where the recovery is still fragile, it may be appropriate to reverse consolidation. And that, of course, is OECD speak for reversing cuts. They also say doing so could support growth without worsening debt ratios. Now, with our Chancellor increasingly isolated internationally, we will continue as a trade union movement to call on him to think again. But of course, it's not all about demand. Supply-side policies, the ways that our government intervenes in the economy at a micro level, matter too. And from the TUC's perspective, there are plenty of levers to pull. The answer is categorically not more deregulation and flexibility that only benefits employers, a trip down the 1980s memory lane, but rather a modern, intelligent plan to make our workplaces fairer and jobs better. We need an active industrial policy to deliver the jobs, skills and growth to the regions that need them most, including, I would specifically add, currently those communities being devastated by the crisis in the steel industry. And on the broader canvas, as the OECD say, an industrial strategy to tackle climate change rather than sticking our heads in the sand as the current government seems to be doing. Now, at the heart of this must be a better system of vocational education, and not just more apprenticeships, but more high-quality apprenticeships so that young people get the chances they deserve. And while we were really pleased to be involved in the bank's open forum, the message is still that reform of the financial system has fallen far short of where it should be. Now, I saw that the Chancellor he may have compared bad bankers to shoplifters, but the language that most working people I know would use is somewhat more colourful than that. Instead of underwriting yet more financial and property speculation, stoking up the next asset bubble, it's high time our banks met the investment needs of the real economy. And the government needs to take the lead by creating a properly capitalised state investment bank to finance some industrial success stories and the good jobs of the future. And when it comes to the labour market, we need a stronger framework of employment rights and stronger enforcement of those rights too, not just to prevent exploitation, but to provide a basic floor of decency in our workplaces. As many of our European neighbours have shown, strong rights, collective bargaining, and a voice for workers are not a hindrance to success, but rather a strong foundation for it, something that we hope the Prime Minister would remember as he sets about his renegotiation package in advance of the European referendum. So to our third priority, it's got to be a stronger voice for workers. We won't rebalance the economy unless we rebalance the employment relationship, that relationship between capital and labour. People at work need a fair say in how companies are run and how pay packages are set, and that helps productivity and the creation of more successful businesses in the long run too. That's why the TUC will continue to make the case for stronger information and consultation rights, for new industrial bodies in low-wage sectors to be charged with raising pay and productivity, and for worker representation on company boards and on top pay committees. We spend most of our waking hours at work. For us, democracy matters just as much industrially as it does politically. As the evidence shows, from employment rates to R&D spend, the countries with the strongest participation rights for workers reap the highest economic rewards. And one of the best ways to guarantee a fair distribution of those rewards is through strong trade unions. Rather than the government's trade union bill, which seeks to weaken organised labour, there is an overwhelming case for shifting the balance of power workers' way. At a time when even the OECD and IMF are expressing alarm about growing inequality, I think that the political class needs to wake up to that simple truth. Now, last month, the University of Greenwich and the New Economics Foundation published a report setting out the value of strong trade unions to the economy. And it shows that restoring union density to 1980s levels would boost wages share and add over £27 billion to UK GDP. And it calculates that the decline in union density has cost up to 1.6% of GDP. Food for thought for those who believe that weakening trade unions somehow strengthens prosperity. As the authors argue, they say the ongoing bias of policy towards restricting trade union rights, at least partly motivated by the intention to deliver higher economic growth, is profoundly ill-conceived. the UK has collectively paid a heavy price for 3 decades of anti-union policy and law. So there you go, a focus on good jobs right across the UK, a macroeconomic policy approach that recognises a role for both demand and supply, an active industrial policy, a new approach to vocational training, and a proper role for worker voice, together with serious and genuine reform of the banking and financial system. It's clear that we do need a new national conversation about the world of work and its role in building shared prosperity. Rather than attacking trade unions, government should be involving what is the largest democratic movement of working people for equality at work. Some seem to forget all too easily that working people are the real wealth creators. But without them and their unions, we won't be able to build a recovery that lasts, nor one that delivers what we all want, I think: decent jobs, great public services, and fair shares for all. Thank you.